So hello and welcome everyone to our first video investment bulletin update. Doing a video for the investment bulletin is something that I've been wanting to do for a really long time. Every quarter there's so much that happens in the markets and in the investments, and I always have to kind of limit and condense it down into a one-page document that everyone can read in our investment bulletin email update. So for a while now, I've been thinking that a video would be a much better way to update all of our clients. I can talk a bit more freely and hopefully go into a bit more detail than what you're used to having about what's going on behind the scenes. But also my hope is that it's actually a more hopefully interesting and engaging way to get your investment bulletin update instead of just simply reading my analysis and my recommendations over the last quarter. Of course, all of that said, it is about what you want, not about what I want. So I think this is hopefully going to be a better way of delivering the investment bulletin. But in order to know that, we need your feedback. So at the end of watching this video, if you have found this much more useful and interesting and you think this is the better format and the way for us to deliver our investment bulletin update, then please just drop us a quick email and let us know your thoughts. Did the sound quality come through okay? Was it easy enough to watch it? Let us know if this works for you, or if you would prefer just to have the written summary and analysis of the markets over the last quarter, then let us know and we'll go back to that. So please give us our feedback that we need so we can make sure that we deliver the service that you really want. So coming away then from that and actually focusing on what's gone on in the last quarter and where we're at with investment performance. So we're going to talk about a couple of things. First of all, we're going to talk about the US and of course Donald Trump, as well as obviously the trade wars that are ongoing with the likes of China. We'll also talk a little bit about Japan and emerging markets, sort of two polar opposite stories there. And of course, we couldn't not talk about Europe, the UK, and the impact of Brexit. Now, I know talking to clients, they are absolutely sick to death of hearing about Brexit. In the media, it's nothing but negative news, and I think we can all agree the negotiations have been handled absolutely shambolically. But it is an important topic, so I'll try not to get on my soapbox too much, but we do need to make sure that you're all well informed and updated with about what's going on behind the scenes to make sure that all of our clients' investments are protected against any downsides from Brexit, but also that we're making most of the opportunities that Brexit actually gives us. So it's not all bad news. There are some good points to take away. So we're going to talk about Trump and the United States first. It's been interesting. I was someone who thought we would never see the day that Donald Trump would become president of the United States, but here we are nevertheless. And I have to say, he's actually doing, economically speaking, fantastically. You know, speaking to the fund managers over the last quarter, I was actually up in Newcastle in September at the True Potential head offices, speaking to some of our fund managers there. And I think one of them said it quite perfectly. Donald Trump is treating the US like a business. He's running the country like it's his company. And from an economic perspective, it's paying off. Unemployment over there is the lowest we've seen since 1960s. You've got more people in work with more disposable income. They're paying less taxes. The corporations in the US are paying less taxes. They're investing, they're expanding, they're hiring more people. And it's that cycle that is just creating this prosperity in the US, which means they are leaps ahead in terms of growth. Year to date at the moment, the US is up about 14%. The only country that comes anywhere near to that in second place is Japan, who are up at 5%. So it just shows you there's a massive difference, and the US really is leading the way in terms of economic growth. And understandably, our investors and our fund managers are taking advantage of those opportunities, and more of your money is being invested into the US at this moment in time because that's where the opportunity is. Interestingly, speaking to the fund managers, it's felt that we've probably got about 12 to 18 months maybe of more growth opportunity from the US before things might start to plateau or become actually a bit too expensive and a bit overpriced to invest in the US, and then we'll be looking for the new investment opportunity. But the other thing that was really interesting is that, again, despite not really believing that we would end up with Donald Trump as president, actually looking at the performance, looking at how the people are responding to the fact that he's delivering on his promises and what he said he would do, it's very realistic now that we will end up with Mr. Trump getting a second term and serving as the President of the United States, unless he does something stupid like getting himself impeached. And of course, in this day and age, never say never. But all of those things aside, we are expecting a second term from him. And again, that continued economic growth and benefit from the way in which he's running the country in very much an isolated way. He is bringing all of that prosperity back to the US and looking out for their individual interests. Now, globally, we might be worried about what that means for things that, as a global humanity, we should be worried about in terms of climate change and human rights and all of those things that we should be working on together. And obviously, of course, Donald Trump has caused lots of waves and ripples in those areas, and all of the rhetoric with the trade challenges is with China. You know, he's doing what he said he was going to do. So even if globally we might not understand this fascination and why so many people in America are loving him, over there in the States, he's doing really well. And it's going to be interesting to see what comes out of the US over the sort of medium to short term. So definitely at the moment, that's what's hot, and the fund managers are taking full advantage of that. Now, like everything, there are winners and losers. So actually the US doing really well has had a negative impact, though, in the emerging markets. Some people might find interesting, but for a lot of emerging markets, a lot of emerging economies, they are borrowing money from the US to help build their infrastructure and get them going on that economic journey. And so borrowing money from the US has been great, but as the US is doing so well at the moment and the dollar is so strong, it means that the cost of that borrowing and servicing that debt is becoming quite expensive for the emerging markets that have borrowed from the US. So we've actually seen in the last quarter a little bit of a drag down on the emerging market performance as a result of that increased cost, if you like, of borrowing. That said, it's not all doom and gloom. As I said, it's not just the US that's doing particularly well. Japan also doing fantastically well, albeit not growing at the same level as the US, only 5% roughly up year to date, but still a fantastic growth story and opportunity there, which our fund managers, again, are looking to take advantage of as they move away from investing in the UK and in Europe at that moment. So that kind of nicely gives me a segue into talking about Europe, the UK, and Brexit. As I said, not wanting to get onto my soapbox, but it is so frustrating on a daily basis to hear just more and more negative news in this area. All that happened, regardless of whether or not you voted to leave the European Union or to stay in the European Union, all that needed to happen was that our political leaders put all of their party politics aside and we negotiated with the European Union as a united front. That, unfortunately, as we've seen, hasn't happened. We've had infighting and bickering and backstabbing, and none of that sends a message of strength as far as I'm concerned when we're going to negotiate the table with the right deal. So we're now actually hearing and we're seeing in the news a real premise that we might leave the European Union without any formal deal whatsoever. Never mind this issue of whether we'll get a hard Brexit or a soft Brexit. So it's incredibly stressful, I know, for a lot of clients to keep hearing all of this negative news. And of course, it's worrying about what it might do to investments. So I think it's quite important that we spend a little bit of time just talking about, again, what the fund managers are doing. So first of all, Europe at the moment is still outperforming us here in the UK. So again, the fund managers are looking not just to Japan and the US to deliver us growth at the moment, but they're also looking to Europe as well. The UK has fallen out of favour in terms of investments at the moment. It is that uncertainty, it's that unknown about Brexit that causes markets to be uncomfortable. And so a lot of the fund managers are moving a lot of their holdings away from the UK and reducing that level down. But actually, talking to the fund managers, no one's particularly worried that Brexit will have a long-term economic impact. Whilst growth, yes, will slow and the economy may sort of plateau or stumble along for a bit, it's not thought at this moment in time that regardless of whether or not we leave with a soft deal, a hard deal, or a no deal situation, that any of those outcomes would actually plunge the UK into recession. It's felt that we are strong enough, that we are stable enough, and that life will carry on. But it's the uncertainty about exactly how it's going to shape up when we leave in March that causes a lot of this concern at this moment in time. And I think it's fair to say, actually, that companies, I think, are using this uncertainty as an excuse. They're using Brexit as an excuse to not expand their businesses, to not employ more people, or innovate into different areas. And in fact, some companies are using Brexit as an excuse to even shrink and make massive redundancies, which again, all of that just feeds that negative news. But the reality is, once the deal is known and we know exactly how we're going to be leaving, and we've left, then life can carry on and we can get back to focusing on growing the economy, and everyone's attentions can be diverted to what's really important, which is making sure the long-term UK prosperity is achieved. I think the interesting thing as well is that we get so hung up on the fine detail of whatever the deal will be for when we leave the European Union, but that deal won't necessarily be the deal that is set in stone. It's perfectly within reason that a future government or leadership may well decide in a few years to go back to the European Union and renegotiate terms, find out bits that aren't working and bits that are working, and go back to the European Union and say, well, we need to talk about some aspects that aren't working for us as a country and try to renegotiate. So whatever deal we end up with come the 27th of March, it doesn't necessarily mean that that's the permanent deal that we're going to be left with. So I think we do have to have some perspective on that matter. As I said, none of the fund managers are anticipating that the impact of Brexit will be so severe that we would end up into a recession. But what the fund managers are talking about quite seriously, and what we are aware of, is that whenever we've seen concerns or worries about Brexit and the impact, it seems to play out first in the currency market. So it's kind of felt that if we end up with a hard Brexit or a no-deal Brexit, we'll probably see the price of sterling come down. Whereas if we end up with a good deal or a softer Brexit, then we'll probably see the price of sterling increase. Now, the irony of that is that actually for our clients that are invested globally around the world, a drop in the price of sterling in the event of a no deal or a harder Brexit would actually probably see the values of your portfolios increase due to how much of them are held overseas. Whereas actually a good deal Brexit, whatever that looks like, and a softer Brexit that would see sterling increase in value, means that actually we could see the overseas part of the portfolio decrease in value just purely from the currency movements. So in the short term, seems a bit counterintuitive, but actually a no deal or a harder Brexit could work in favour to the value of your investments. Longer term, however, for better economic stability, of course, we do want to achieve a good deal that works for the UK and the European Union. And it's still hoped by fund managers that that will be achieved. But I think we can all agree that time now is getting exceptionally tight. So behind the scenes, what the fund managers are doing are not just making sure that we're invested outside of the UK, but also they're working tirelessly to work with the currencies in which you hold your investments and to really hedge our bets about what currency movements will do after Brexit is actually finally negotiated on, or we finally leave with or without a deal. So that's what's going on behind the scenes. What was interesting and what made for me, it kind of gave me a different perspective, but it's so frustrating that that isn't then talked about in the mainstream media, is that actually there's a fantastic growth opportunity for us here in the UK after Brexit. Right now, everyone's uncertain, everyone's being driven by emotion and not liking to invest here in the UK. But post-Brexit, once we're out and we know what the deal is and we can continue to trade and have good relations with everyone, actually, it gives us a fantastic opportunity because the value of the UK at the moment is very undervalued. No one's really investing here. And it's a fantastic opportunity for our fund managers to take advantage of Brexit, actually. And once it's all done and dusted with, actually bring investments back into the UK and take advantage of what hopefully will be a very nice growth pattern that we'll see once all of this uncertainty is behind us and we're out of the European Union. So it was really interesting to look at what the fund managers were doing to protect in the short term against the downsides of Brexit, but actually seeing the potential growth opportunities here in the UK once Brexit is over, and making sure that they're set up to take advantage of those once we get past the 27th of March. So essentially, as I said, it's not all doom and gloom, despite what the media would have you believe. It is tough economic conditions and market conditions at this moment in time. There is a lot of uncertainty, yes, but what we've seen in the last quarter is that performance has been muted, most certainly. It's sort of started to plateau over this last quarter, and we'll possibly see it continue to plateau for the next quarter as well, until we have a bit more certainty around Brexit. And then, as I said, that confidence and that emotion will come back, and then we'll start to see some much more positive growth. But it is important for all of our clients to remember that you're not invested 100% in the UK or the FTSE 100 for that matter, and that you do have a globally invested portfolio. And so regardless of the strains and the economic conditions here in the UK and even inside Europe as a result of Brexit, it's really important to remember that actually there's a big world out there and we're investing in all of it. So there are still opportunities for growth inside the portfolios. So based on all of that, I'm very happy with what the fund managers are doing behind the scenes to protect our clients and to also take advantage of the growth opportunities that are still out there. I feel quite confident in their strategies and looking at the performance in light of the market conditions and what other benchmarks are doing. I think it's reasonable in terms of the last quarter's performance, and I've got no worries and concerns moving in to the next quarter. The exception to that is for those clients that are invested in the Spectrum portfolios. So for those of you that are invested in those portfolios, you'll know that over the last quarter, they've been on our radar with regards to their performance being below expectation. And we are making a recommendation to make a change to that particular fund manager, but we will have written out to you separately with regards to those fund changes and the recommendations and the reasons why. If you've received the letter and you have any questions about why we're recommending a change to that particular fund manager, then please, by all means, just give the office a call and let us know. We'll arrange for a meeting and I can talk you through some more bespoke detail. Lastly, it is that time of year again for your annual attitude to risk review. So in the email that has been sent to you containing this video update, there is a link to a SurveyMonkey questionnaire. It asks you just two questions. Either one, are you happy with your attitude to risk at this moment in time and don't want to make any changes to your risk level or investment strategy? So that means you don't want to take any more or any less risk and you're happy with the risk that you're currently taking in your investment portfolio. If that's you, you can tick that one and then send the questionnaire over to us. Or you have option 2, which is where you think your attitude to risk might have changed. So you either are thinking about taking more risk in your investment strategy or maybe less risk in your investment strategy, and you want to have a chat about it. If that's you, then you can tick option 2 and send the questionnaire in to us, and my team will then give you a call, and again we'll arrange for a meeting so we can have a little chat, see what you think's changed with regards to attitude to risk, and then we can talk about whether or not we need to make a change to your investment strategy in light of that. So if you can please give your attention to that link in the newsletter email that you've just received with this video, that would be greatly appreciated. As I said, all importantly, over and above anything else, please also give us the feedback about how you found the investment bulletin video and if this format works for you, so we know whether or not you'd like us to continue doing them. I hope that was useful. I hope that was enjoyable. Obviously, if you do have any questions from the quarterly update and anything I've said, then again, please give us a call and we'll happily answer those questions. And I look forward to hopefully speaking and seeing you soon.